So welcome to this video. In this video, we are going to discuss about standard costing. So this is a lengthier topic. Okay, standard costing is very important, and there are like several formulas and techniques are here. So it requires a lot of theory to understand the concept, and we also require a lot of problems to understand the concept. So first, we'll start with the theory, and we'll fully go through it, and thereafter we'll go through the what are the variances. Okay. So standard costing is the preparation and use of standard costs, their comparison with actual, and the analysis of to their causes and the points of incidence. Okay. So first we'll understand like what or where this concept is like helpful. So first we'll move this entire variances down. Okay, so that we can work out here. We can work out this concept. So we'll start with the meaning. Standard costing is the preparation and use of standard cost, their comparisons with actual cost, and the analysis to their causes and points of incidence. Okay. So assume that you are going to produce a product. So will you keep on producing the product and then you will get the cost and then will you like price it and sell it to the customer? So will you like do like this? You produce, right? Thereafter you know what is the actual cost. Okay, you produce the product, thereafter you get the actual cost. The actual cost comes to something like 100. After that, will you add a profit and find out the selling price? Will that work properly? Okay, because if you are going to get a if you are going to add 20, for example, if you are going to add 20% of whatever the cost is going to be, this will be 20 and your selling price is going to be 120, right? But this would be for in January it is like this. So in January it is like this, but what happens in Feb is like quite different. Okay, in Feb what happens is this cost goes to 110 and now you have to make a profit on it. So 20% of profit on that becomes 22, so your selling price becomes 132. In March, okay, in March you're going to again produce a product. At that time it becomes 90 and your profit is going to be 18 and your selling price is going to be 108. Number one, can you keep on changing the selling price? Will it cause a confusion in the consumer's mind or the customer's mind? The answer is simply yes. It is going to cause a lot of confusion because they don't know why they are paying a higher and lower amount each month. Okay, so what is the cause of problem is you cannot make a pricing based upon your actual cost. Okay, see, we can't expect the consumer, okay, to take the inefficiency or efficiency of our production. So sometimes we are very efficient, sometimes we are less efficient. So that cannot be like that headache cannot be passed on to the consumer. So what happens is we should not just like do like this. Okay, actual cost and profit. What we should do better is we should produce. Okay, we should produce, but our pricing should be based upon standard cost. Should be based upon standard cost. Okay, so the standard cost of the product is going to be the 100. Okay, so every month it's going to be the same 100. We are not going to change that at all. So every month our profit would be 20. Okay, and the selling price every month it's going to be the same 120, right? So this gives a much better feeling to the consumer because he can buy the product at any month at the same price. So this gives him comfort. But uh, is our problem solved? Okay, the answer is no. See, our headache is not solved just because we are going to charge the cost based upon standard. Our problems are not evaporating. Okay, it's still there. Why? because we have to produce the product at 100. That's our standard. So but there is a difference between the standard and the actual, so that difference is called as variance. That difference is called as variance. Okay, see here there is no difference, right? So standard minus actual, there's no difference, so 0 is a variance, there's no change. But here there's a negative 10 variance. Okay, negative means it is not a good thing for the company. So there is an increase in the actual cost when compared to the standard. So in the next month, if you see, it is a good thing for the company because they are producing the product at a lower cost than the standard. Okay, so this mechanism seems to be way better because we cannot pass our inefficiency and our efficiency to the customer because it will cause confusion like this. It's better to charge the customers a standard cost so that the selling price would be standard and same, but internally we have to find out where we are doing good and where we are not doing well. So that helps in the variance analysis. So this part is called as variance analysis. Okay, so we can also think like this. For example, assume there is a difference between these two costs. Okay, between the actual cost and the standard cost, there is some difference. So the difference is around some 100. The actual cost is 110 and standard cost is 100. So we can't, it's not much useful to just get a variance like this. You can't get a variance of 10. So that is not much useful here. Okay, what would be much useful? Okay, would be a very bigger split than this kind of numbers. Okay, so a bigger split would be we can show it like this. What is the material price? Okay, what is the difference in the material price? What is in difference in the labor or production cost? Or what are the other overheads like variable overheads? Okay, how, because of that, how much of changes in the two are becoming there. So these things should be and can be shown. Okay, so even fixed overheads, we can even show fixed overheads. Okay, so the total cost of the product, we can show a split and then it would be much more useful. Okay, so how did this first standard cost of 100 is formed? Because it is 25 for material, 25 for labor, 25 for variable overhead and 25 for fixed overhead. That is how the standard cost of the product is like arrived. Okay, and the actual is like quite different. The material cost has gone up by 40, but the labor cost has gone down by around to 15. Okay, and variable overheads, so fixed overheads we'll take it as 25, the balance number, okay, whatever this balance we put here, and the fixed variable overhead goes to a cost of 30. Now we can easily find out, okay, where the variances are occurring. Okay, in terms of material, if you take, there is a 10 okay, one second. There is 15 negative variance. Okay, and in labor there is 10 positive variance. In variable overhead there is 5 negative variance, and in fixed overhead there is no variance at all. It's the same. So this table gives a much better picture to the company to take actions. Okay, because if they just find out the standard cost and actual cost are differing, they don't know where it is increasing or where it is decreasing. Okay, but when you give a table of split between the materials as well as standard cost and actual cost, it pinpoints where the problem is. So once they know the problem, they can take some kind of an action. Okay, actions such as, here they have to investigate why the cost has gone up. They can investigate. And in labor, they have to repeat, they have to investigate and repeat the success, okay, because they have got a favorable variance, they have to repeat it so that in the next month the same thing again repeats. Variable overheads, they have to investigate it and prevent. Next month it should not occur. So next month it should not occur. So it's all about investigation. Whether it is preventing or repeating it is the question. See here in fixed overhead, we don't need to take it can be like no action. You don't need to take any action because it's as per line with the what we expected. Okay, so just finding out the difference is not the concept. The concept is to okay, so the concept is to find out where the variants are occurring, okay, and we are trying to stop that negative variances, and we are trying also to repeat any positive variances. Okay, so that's about the concept here. So hope you got a good idea about what is variance. So now we'll move on to the components of standard costing. So the first one is standard costs, which provide a standard or predetermined performance level. So that is what the standard we have here. A measure of actual performance. So what has happened in the actual, we compare the standard and the actual. A measure of variance between the standard and actual performance. So that is the variance. Standard costing uses estimated costs completely to calculate all three elements of production cost. So we need to know how the production cost is differing between what we thought and what has been occurred. So in terms of direct labor, direct material, labor, and overhead. So we'll move on to the variances. So in terms of the variances, these are the steps that we have to follow. The first one is compute the amount of variance. So that is what we have done it here. And determine the cause of any significant variance. Okay, what is the cause for it? Okay, and we have to take an action, identify performance measures that will track those activities, analyze the results of the tracking, and determine what is needed to correct the problem. So find out what is the problem, underlying problem, and try to solve that problem. Take corrective action. So that's about, I think, that we have done. So variance analysis, I hope you have understood it. So what is the benefit of doing this standard costing in the first place? It is a very useful tool to control the cost. Okay, so we have set a standard and our cost should go only up to that standard. It should not go beyond that. The two is, it is the analysis of variance which reduces the cost and increases profitability. So we are trying to find out where and how our cost is increasing and how to reduce it and how to increase our profitability. It is also beneficial for management because it assists in the fixation of selling price. So hope you got that idea from this explanation. If we charge actual cost, it is very confusing for the customer. We should charge a standard cost. Okay, so standard costing helps in the fixation of selling price, ascertaining the value of closing stock, of work in progress. See, you can find out what is the worth of closing stock based upon not on the actual but on the standard cost. Okay, on the standard cost you can find out what is the closing stock value. You can determine idle capacity. So idle capacity can be easily found here. If laborers are not used properly, it will lead to idle capacity. So here if you see, it is fully used, okay, and they are also giving some good variance. The standards provide incentives and motivation to work and help in increasing efficiency and productivity. So the standard costs, okay, see, all of this cost is a responsibility of any one manager. So for example, material price is responsibility of the purchase manager, labor cost is the responsibility of production manager, like that. Each manager is responsible for a particular line of costs. Okay, so we can fix incentives for reducing the material cost, labor cost, and if they reduce it, that particular manager responsible for that, we can give them an incentive. Okay, so that's about the good things about standard costing. So is there any bad things about standard costing? See, yes, there are bad things here. From where did we find out the standard? The standard itself can be wrong. Okay, so we can say that so that's about the establishing standards is difficult. Okay, the next one is standards are determined by keeping in view the market conditions, availability, and efficiency of labor, machine, and plant. So the standards are established at a normal level, and with the existing circumstances, we are creating a standard. Okay, so a raw material price today might be 25, so that's why we have fixed a raw material standard cost of 25. But in 1 month time, who knows where the price will go? It might be going up to 40. So even the manager there cannot do much here. Okay, so laborers are charging 25 currently. Due to efficiently we are making them to work, so they are coming at 215. Okay, so we don't know exactly where the cost can go up or down. The standard is fixed as per the current circumstances, but we should never know where the numbers will move in the future. All these factors, so these factors will not be staying constant. So the price can go up and down. So we cannot say the standard is always a proper number. Standard costing requires specialist and expert staff. So setting the standard itself cannot be done by all people or even a financial accountant. It can only be done by a management accountant who studies all the variables properly. So it requires a consultant from outside or a full-time management accountant. This involves heavy expenditure for the concern. So not all companies can afford this because there is an expense in terms of appointing a management accountant or appointing a consultant, getting all the data in terms of standard or fixing the standard, then getting the actual cost of production in terms of material, labor, variable overhead, like that. So it is not so easy work and all. It is going to be a time consuming and cost consuming work. So these are the drawbacks of standard costing. Let's look at the different types of standards which are available. So there are like four different standards are available. Number one is basic standard, ideal standard, attainable standard, and current standard. Okay. So we'll start with what is a basic standard. So these are long-term standards which remain unchanged over a period of years. So we can't, is it a good standard? See, the answer is no. Basic standards are not good standards because these are standards which are established a long time or a long period of times back. So the material price could have changed, labor price could have changed, efficiency could have changed. Okay, we would have bought a new machinery like that. Their sole use is to show trends over time for items such as material price, labor, and labor efficiency. So you can have this as a to find out like how the cost is moving. Okay, that you can have. So you set a very old standard, and this standard is actually useless. They are also used to show the effect of using different methods over time. I'm not sure like what's that point, but these standards are the least used and the least useful type of standard. Just because you have established a product will cost 100 rupees 5 years ago, that is inflation. There is machinery we could have bought, labor price can go up, efficiency can go up. So there are like so many variables which can come into play. So basic standard is a very, very bad standard. What is an ideal standard? See, ideal standard is these standards are based upon operating, sorry, upon perfect operating conditions. Okay, so in perfectly operating conditions, the standard is the sorry, or else we can say like this: in an ideal environment where the machine works perfectly, laborers work diligently, and material price are exactly we can obtain as per our expectation, then that is called as ideal standard. See, this cannot be followed. Why we cannot follow this ideal standard is, see, when we buy material for something like 10,000 kg, few kgs will be lost in the transportation itself. Okay, see, this cannot be, we cannot do anything for that. Or else the cost of improving the transportation will be so high, it is useless to improve the wastage in transport. See, and it never allows no any scrap. All items have to be perfectly produced. It assumes that the machine will keep on running. See, it assumes the machines are not going to break down. The There's no stoppage at all in the work for any reason, and employees are going to work, assume they have to work for 8 hours, exactly 8 hours they keep working. So this kind of perfectness we can never expect in real world. Okay, we have to allow for some kind of lower target only we could have. Okay, so in search of perfect quality, companies can use ideal standards for pinpointing areas where close examination may result in large cost savings. Okay, so this would help you to find out where the biggest expenses are being incurred. That it will help, but it will not help in improving a lot of things. Okay, ideal standards may have an adverse immotivational impact because they are unlikely to be achieved. See, every variance is a responsibility of some particular manager. That's what we saw. If this material manager, okay, materials manager, if he sees like a variance, negative variance, once he won't be much frustrated. But throughout the year and throughout all the years, if he keeps on seeing only negative variance, he will be demotivated. Okay. And if you are going to fix a salary or incentive based upon a favorable variance or a good variance, he is never going to achieve that kind of good variance in his life, because ideal standards can never be achieved. So he will become demotivated. Okay. So that is a problem with ideal. So this also cannot be used. So what is attainable? The third one. See, attainable is these standards are the most frequently encountered type of standard. So all companies use this only. This is like similar to perfect, but they allow for inefficiency also. The normally expected inefficiency, such as material loss will be there, laborers will become tired, machine breakdowns will occur. Okay, so we allow for realistic kind of uh, uh, things. Okay, so that's why it is called as attainable standard. Attainable standards must be based on high performance level, so that's with a certain amount of hard work they are achievable. Okay, see here the target is, if you can produce a product at 100 rupees, okay, they will ask you to produce a product at 98 rupees. See, that's something like, okay, if you push a little bit hard, you can produce at 98. So this is something which is attainable but also a little bit difficult. It's, we can't say difficult, it is challenging. Okay, so if you fix a attainable standard, it is challenging. For example, if you are going to write an exam, ideal standard is you have to score 100. Is it possible? In all exams, the answer is no. Even if it is possible and you are trying for it, there's many times you might not score 100. Okay, it can be like one question is out of the syllabus, or one question is like so much tough, or you have not read a small part of the book. So getting 100 out of 100, okay, is like very very difficult. Okay, and over a long period of time, it's like very difficult. Okay, attainable is, if you are a person who's scoring 60, we can ask you to score some 75, at least as an improvement. Okay, when you are scoring 75 consistently, we can ask you to score something like 85. Okay, we can push your attainable standard a little bit higher and higher. Okay, and what is the last one? The last fourth standard is current standard. So whatever is the existing standard, whatever the existing actual thing that you are achieving, that itself we set as the standard. For example, if you are a student scoring 60 marks, your standard is fixed at 60 itself. Okay, how can that be? So that is how your current performance is set as a standard. Will it help in improving anything? The answer is no. It will never help in anything. So the student will only be scoring again 60. At one point of time, he can even score lesser marks. Okay, and he will try to boost it only to 60. Okay, so that is the drawback of current standard. So out of the four standards, basic, ideal, attainable, and current, attainable is the only useful standard which is followed by all organizations. Okay, so the final element is, why do we have variance in the first place? Why does the material cost, actual material cost, and standard material cost they differ? Or why is like actual labor cost and standard labor cost they differ? So why is this difference occurring? Okay, why is this difference occurring? So this difference occurs because of four reasons. Okay, one is planning. The standard itself is wrong. Okay, the standard itself is wrong. So that can be one of the reasons for the cause of variance. Okay, the second one is measurement is wrong. The measurement in terms of the standard or the measurement in terms of actual. For example, we want to find out, are we like how much we are spending for the purchase of material. Okay, so uh, or like we can take for labor. Okay, we thought the employees will work for 100 hours, okay, but they have worked only for something like 80 hours. Okay, what happened? What has happened between the 20 hours? See, in between 20 hours, what happened is for 10 hours there's no record at all. People have worked, but there was no proper recording or maintaining of books. Okay, so we can't say this is as a, see, this problem is not in terms of the efficiency of workers. It's the problem lies in the in terms of recording the actual numbers. Okay, so non-recording of the data, okay, or wrongly recording the data can become the measurement error. So it is not that standard costing will exactly tell you that the problem lies in the operational or the work. It's not like that. Even the measurement can be wrong. For example, you write an exam, you write an exam and you thought of scoring 80 marks. You are currently scoring 60. You thought of scoring 80 marks and you have written. That's your target. But when the results come, they are not. They are around some 70. Okay, you are currently 60. You want to score 80. That's your target, but you scored 70. So why have you not achieved? Can we tell that the difference between what you are currently achieved, your actual 70 and the target 80, 10 is the mistake? See, we can't tell that is your mistake alone. It can also be the mistake of the person who is correcting your paper. Either your handwriting he is not understanding, or one of the paper that you have written is like a tone of somewhere and is like not available, or in counting the total marks, the valuation per the person who's valuating your paper has missed the total. Okay, in additioning, so there can be some measurement error will be there. It can also be of random factors. Okay, see, sometimes when you buy, the price can be high, low. Sometimes laborers will be, when you give a Diwali bonus, laborers are very motivated, so they'll work better. Sometimes there is like a bad relationship between the management and the workers, so the efficiency drops. Okay, so it is not only the things which are under the control of the manager. There are many things can affect the workers workers nature, or material cost or variable cost, like that. Many things can occur. We can never know what is going to occur. The last one is the operation factors. See, these are the factors which are under the control of that particular manager, and he can control that cost. For example, laborers have to work 100 hours, they are only working for 80 hours. The production manager has to motivate them, boost them, okay, or speak like friendly with them, and he has to push them to work for 100 hours. Okay, so that's about the concept here. So just because there is a variance, it does not mean that the manager is not performing well. We can't say like that. It can also be the problem that standard is wrong, measuring the actual is wrong. There are so many random factors which can influence the actual, so that also plays. And the one element of this causes is operational. Okay, so the concept is, don't blame the don't blame the manager for the for negative variance. Even for positive variance, good variance also, sometimes he might not be responsible. He might be just in a lucky situation, he gets a luck. Okay, so that's about the concept here. Hope you have understood about the theory of standard costing. So we'll start from the problems.